Several investors and experts now believe that the US is in an economic recession despite the government saying otherwise. One of these experts is Real Vision CEO Raoul Pal. We have done several videos on Raoul Pal, and he has consistently provided us with concise analysis regarding the economy and some cryptocurrency as well. Raoul Pal recently discussed the country's current economic situation in an interview with Abra CEO Bill Barhydt. Join us in today's video as we hear from Raoul Pal. Before we begin with the video, we appreciate all your support for our channel, and we'll be sure to provide more informative content in the future. The statistics published by the Bureau of Economic Analysis of the United States show that the economy of the country has shrunk for the past 6 months in a row. The US gross domestic product decreased by 1.6% in the first 3 months of the year. Additionally, the latest data shows that the US GDP is shrinking by 0.9%. Traditionally, a recession is defined by 2 quarters in a row of declining growth. However, the government of Joe Biden is confident that the US economy has not entered a phase of deterioration. Treasury Secretary Janet Yellen had earlier noted in an interview with CNBC that each month still sees the creation of more than 400,000 jobs. Therefore, she argues that a recession cannot be occurring.
But we are at full employment. We have a very strong labor market that's been achieved, but inflation is way too high, and it's really a big burden on American households. And so maintaining full employment while bringing inflation down, that's the president's priority.
Additionally, the government of President Joe Biden has indicated that substantial economic progress has been made since the closures that occurred during the COVID period. The president addressed the nation a few weeks ago and told them, "That doesn't sound like a recession to me." This announcement came shortly after the BEA issued the GDP figures. Nevertheless, many economists and financiers disagree. It's been a rough few months for the world's largest economy, and CEO Raoul Pal of Real Vision discusses why he thinks this is a recession in a recent interview. Moreover, the macro expert discusses valuable indications that investors can use to gauge the macro climate. The ISM Manufacturing Index, also known as the Purchasing Managers Index, is among these statistics. It is a monthly measure of economic activity in the United States that is derived from a survey of purchasing managers and manufacturing enterprises. It is widely regarded as an accurate measure of the health of the American economy. You may learn more regarding this vital economic indicator in the present macroeconomic climate from Raoul Pal.
Okay, firstly, the thing that gives you the best guide is something called the ISM survey. And you can Google it, you can find it, it's publicly available. And that basically, anything above 50, the economy's expanding. Anything below 50, it's kind of stalling. And anything below 47 is a recession. And that's been going since about 1947. It's an incredibly good indicator and really useful. So think of it as a kind of weekly version of GDP. So that gives you a very quick ballpark. And what's really interesting that no economists figure out, and I don't understand this, is it goes up and down. It's cyclical, right? Economists have linear projections. It's like, really? You can show a small child a chart of GDP and they go, well, it goes up and down. So what it does, if you see it going down and crossing 50, you know we're likely to be headed into a weak patch or a recession. If it's coming up from the lows, we can start looking forwards. So that's a really simple guide. The other way is the bond market's usually very good at this. So once yields start falling, bond markets are generally derive their price action from 2 things, GDP growth and future inflation. So if bond yields are rallying, it's saying that GDP is probably slowing down, i.e. there's a chance of stimulus to come and bonds look a safe haven. And secondly, that inflation is likely to come down in the future. So those 2 things alone give you pretty much all you ever need to know. Now, what's really interesting, the second degree of all of that is there's a bit of magic. So you look at this ISM survey, you go, well, how does it help me with my equity allocation or my allocation? All you do is turn it into a year-on-year chart. And all of the year-on-year charts of every asset, from oil to bonds to commodities, to copper, to equities, to emerging markets, to credit spreads, are all the same charts. They're driven by the business cycle. And some things are pricing in more right now and others are pricing in less. So the bond market's pricing in less, as is the oil market. But things like tech stocks are pricing in an ISM of 35, which is a deep recession. So then it gives you kind of a relative understanding of, okay, where should I be looking at allocating my money? So there's some relatively simple tools.
During the course of the discussion, Raoul Pal also discusses the influence that economic indicators such as the ISM and business cycle indicators have on the values of various assets. According to him, when the economy is experiencing a slump such as this one, investors gravitate away from discretionary equities and into utility stocks, which have a tendency to perform significantly better. Let's continue listening to Pal's talk as he continues to discuss the current condition of the economy.
Yeah, I mean, does technical analysis lead to price action or does it not? All I know is if you listen to Stan Druckenmiller over the last 20 years, every time he gives an interview, he says, you know where the economy is by looking at the internals of the stock market. What does he mean? It means things like consumer discretionary stocks versus utilities. If the economy's slowing, then discretionary stocks, i.e. the discretionary spending, tends to fall. Utilities are the things we have to have, so they tend to do well. They're all correlated with the business cycle. The business cycle, I mean, I've got business cycle indicators going back to 1870. They still work. So even though more people might look at them over time, I still don't think it's necessarily the driver of price action. If not, you would have seen more assets price in the same move, but we haven't, right? We've got bonds up here, haven't priced in much of a weakening ISM, and then we've got tech stocks, which are at the bottom, which are priced in a massive amount of weakening. So it's clearly not efficient yet.
Yeah, and we still see contrarians, right? So it seems to me that there's a lack of consensus on, is the Fed really going to have to pivot versus is that kind of long-term trend line downward on interest rates no longer, a viable predictor of where this is going? And so, what should be, over decades, kind of a reasonable road to consensus actually doesn't really feel that way, the way one might expect. Is that true? Or
so always at turning points there is no consensus, because there's a group that extrapolates the recent trend and says that's going to continue, and there's a group that extrapolates a mean reversion. Now the question is more complicated, because we've got these supply issues, we've got onshoring, we've got other things that are muddying the equation, and what we've got is this big debate. So myself, David Rosenberg, and maybe Urian and a few others kind of think we probably mean revert because of debt, demographics, technology, that inflation's not a long-term issue. But there's a whole other group who I really respect who are saying, no, you're dead wrong. Inflation's sticky, it's here to stay, and it's a big problem. And we won't know. And this is the beauty of financial markets, right? It's game on now. We've got the game. We place our bets, and we'll find out who's right and who's wrong.
Sure. But it does feel like in some ways, I realize that the talking heads are always going to be many of them are going to be a trailing indicator, but it does feel like many prices have either peaked or are starting to come down. And that's really what matters here, more than the actual inflation level itself, in terms of, we're going to get into crypto and equities and whatnot, but isn't that a more important perspective?
Yeah, all prices are set at the margin, and marginally all prices are falling, except, even oil's fallen, but not as much as others. But stuff like copper, that's very economically sensitive, been decimated. And we've seen that in agricultural commodities, we've seen it in all commodities. Now, Elon Musk tweeted out yesterday, somebody who'd been talking about the inflation in his supply chains, said, we're seeing prices peak.
Yeah.
Okay. Yeah. He is a consumer of a lot of different raw materials.
That's right.
And he's telling us this. And we're seeing that all over the place. So, so why is it at 9% now? Well, inflation is a lagging indicator. It looks back over prices.
Absolutely.
So So still we're seeing some companies pushing through price increases of commodities that they bought 6 months ago that they've turned into cereal boxes that they've now put on the shelves, right? So it's a delayed process. And eventually the delay comes the other way. The other big delay is rents, because the housing market is slow to move. It's not like equity markets that can move very quickly. So as the housing market comes down and mortgage rates come down, rents will slowly come down. But that can take a while. And it's the same with wages. So we're now just starting to see all the tech companies laying off people, all the crypto companies laying off people. So that's going to be pretty broad-based and pervasive. It's not gigantic because oil companies are doing well and other people are doing well, but that process then feeds through. So usually what happens is 18 months later, 12 to 18 months later, you get the reverse. And I actually think we go to negative inflation, which is not what anybody else thinks.
It's not only Raoul Pal who thinks we're going through a recession. Kathy Wood of ARK Invest recently discussed these topics in a conversation with CNBC and expressed similar opinions.
We think we're in a recession, and we think a really big problem out there is inventories, the likes of the increase of which I've never seen this large in my career.
Despite this, the Biden administration maintains the position that the country is not now experiencing a recession. What is your opinion? Is it possible that this is just a Democratic tactic to save their reputation before the midterm? Or is this merely a blip on the economic radar that cannot be classified as a recession? Share your thoughts in the comment section below. If you enjoy this video, kindly like and subscribe. And we'll catch you on the next one.